Thank you for stopping by to another edition of Hunting the Great Red Capital Gains Shark. We're going to be covering some of these crazy acronyms that you find when you're talking about capital gains deferral techniques. And the ones that we're really going to talk about are DSTs, DSTs, ISTs, 721s, REITs. We're got to throw in some tax codes. It's going to be fun. So what the heck is it with all these different acronyms? Well, let me just hone in on the fact that these are all about capital gains deferral techniques and the structures that you're using to defer the capital gains. So we're not talking about offsetting. We're not talking about charitable gifting. We're not getting rid of the tax. We're just passing the buck along. What are the legal ways? What are all these acronyms about? So we have DST number 1, it's a Delaware statutory trust. It's good for 1031 exchanges, even though it's kind of a REIT, but it's not really a REIT. DST number 2, a deferred sales trust. This is an installment sale variant, and these typically are irrevocable trusts. More on that in a second. ISTs, an installment sale trust. Okay, so we're still talking about installment sales, but instead of an irrevocable trust, we're focusing more on the revocable trust aspects. Private annuity trust, well, you're not really going to run across these. So if you do, we'll have a little blurb on them. Section 721 UP-REIT. This is where you do a 1031 exchange and you kind of go into a REIT kind of like in a sneaky fashion. More on that in a sec too. 1031 rescue or bypass. This is where a qualified intermediary gives you an option in case your 1031 exchange falls through. Now, not all QIs will do this, but there is tax codes that, kind of say how to do it. And then the REIT, the Real Estate Investment Trust. You're not allowed to 1031 exchange into a REIT or out of a REIT because it's multiple properties and you're not managing it. It's managed by a completely third party. So it doesn't really pass any of the tests for 1031 exchange. But if you have a REIT or a closed REIT or any of those variants and you need to try to get out, you can still do an installment sale note depending on how the ownership is. So again, we're talking about gains deferral structures. So we're only focusing on IRC 453, which is installment sales and their variants. And we're really talking about an installment note held a couple of different ways. That's all we're talking about. 1031 exchange is like for like, but we're being sneaky about it, right? We're saying we don't want to exchange like for like. We either want to have a 1031 exchange where we exchange one property for multiple properties held in a REIT, or we want to fail our 1031 exchange, but still not pay the tax. How do we get into a 1031 rescue? So let's discover a little bit about Delaware statutory trusts. This is a peculiar one because it's a REIT, but it's not really a REIT. It's a trust, but it's not really a trust because it has units. So it's a particular type of structure where it feels like a REIT, but it isn't. So for some reason, you can still 1031 exchange into these. They're a little bit harder to find. They're not typically publicly traded. So, there's management issues that could pop up, and it's definitely an illiquid investment. So if you get into these, it's for an income only type play, and you really have to have an extra degree of trust is what I would call it for the management of the multiple real estate properties that you hope to invest into through your 1031 exchange. DST number 2, the deferred sales trust. So we talked a little bit about an irrevocable structure. We're just holding a installment note in a irrevocable family trust, basically. So once you pull the plug on an irrevocable trust, it's very hard to unwind these. So you don't have a whole lot of opportunity for do-overs if you do it wrong. And since you're holding everything for the benefit of yourself and your family, including future generations, then you typically have to have a third-party independent trustee so that you're satisfying all of the IRS's related party transactions. Because anytime you're dealing with gifting and families and tax advantages also, that's specifically against most of the rules. So you have to be very careful with it. As a result, deferred sales trusts tend to be a lot more expensive and have a higher ongoing management cost. And they tend to get penetrated far more often than other more simple and elegant techniques. Like the installment sale trust, which is my personal favorite. This is a business purpose trust. So what you give up with an installment sales trust is all of the profits. You've got a note, say you have an installment note and it pays you 6%. Well, if you earn more than 6%, you're probably not going to get it, but you're going to get your 6%. So if you're happy with that, then all of the other penetrating problems that an irrevocable trust has, intrafamily squabbles, challenges from the IRS in the event of an audit, stuff like that, all of it disappears because obviously it's held for profit. So very easy to unwind and get out of it at a moment's notice. So I like that flexibility. Private annuity trust, you don't really find these anymore. Like I said, in 2006, they were disallowed for capital gains deferral benefits. However, they are arguably one of the most powerful estate draining tools because they deal with mortality as a term. So when you factor your discount rates based on mortality, such as a private annuity would do, then it opens the line up to accelerated gifting schedules. But since this is the great red capital gain shark, we're not really going to talk about estate planning. Still, in case it pops up, now private annuity trust, not for capital gains. The 721 UP-REIT. Okay, so yet another 1031 sneaky strategy to take one property and get it into multiple properties held in a REIT structure. So unlike the DST, we're actually going into a proper REIT. However, this proper REIT has to have a property that it's about to acquire, and you want to buy into that property before the REIT acquires it and makes it part of its real estate investment trust. As you can imagine, there's a whole lot of complexity and uncertain timeframes in this. And once you UP-REIT into a REIT, you're out of the 1031 marketplace. You still can possibly exchange your real estate investments trust units through an installment sale variant or through charitable gifting. But if you're carrying over that basis, well, this is kind of like almost an end play. So 1031 rescue, this is a hot topic in today's age, especially right now in 2022, where we're having a surplus of commercial properties that are extremely overvalued with very uncertain rents. So what's the deal with these 1031 bypasses? Here's the thing, you have a qualified intermediary that administrates your 1031 exchange. The qualified intermediary may offer this as an option. It's kind of cloudy, but they have some rules. They have some line items they spell out. None of this has ever really been tested. But what happens is they're interpreting from IRC 1031 guidelines regarding boot and straddle transactions. So a straddle transaction is where you have a 1031 exchange that takes place over multiple years. By very definition, it's an installment sale because it happens over the course of 2 calendar years. So that's extremely common. They borrow some of that language and turn it into a third party to repay the proceeds held in escrow through a 1031. So we're not jumping tax code to tax code. Okay. What we have is by contract identified before you ever open your 1031 exchange as a party to independently return the funds in case your 1031 fails. And then it effectively turns into an installment sale because it never was a 1031 qualified transaction. And it may or may not take place over multiple years. So really, that's kind of how that one is. They're a little bit harder to find, but typically the mechanism that returns the money is an installment sale trust. So another vote for those. So again, all of these different acronyms, I hope I did a relatively good job of explaining them, but just to hone in on these are all about tax deferral. So once again, we're not talking offsets, we're not talking charitable gifting. Most of these tax codes that you're seeing, there's only 2 that really pertain to this stuff, and that's installment sales and like-for-like exchanges through 1031. So we're only really talking about how we deploy those particular tax codes. That's what all these different acronyms are all about. So thank you very much. And let me know if you guys have any other questions.